This is a complex question. There are lots of areas of risk within a business, so it might be easier to break things down into categories: liability, property, and death and disability. When it comes to liability, every business carries a degree of general liability, where the business can be sued for things that occur while on the business premises or within the act of doing business. So having a general liability policy is a good starting point. If you provide professional services that requires a state license, you'll need to carry professional liability to protect against any claim against you due to acts or advice that may have caused damages. If you have employees, you'll want to have employment practice liability coverage. Being an employer requires you to abide by employment laws, and if you violate any of these laws or your employees feel they were treated unfairly, this will protect you. In a digital world, with personal information always a click away from being misused, sold, or blocked from use, having cyber coverage provides both liability and restoration coverage should your data become compromised. There are other policies such as commercial auto or hired and non-owned auto, where the business needs to be protected from liability if an accident occurs with either a company-owned vehicle or a non-company-owned vehicle during the course of business. And even fiduciary liability coverage for those that have a fiduciary responsibility for their benefits plans to employees. The key is to identify where there is exposure that is not covered under the general liability policy. With property, there are various types of property that you may need covered, from the building itself to all of the business belongings within that building. You may have company-owned vehicles you and your employees drive in the course of business that you'd want repaired or replaced after an accident. Or you may have owned or leased equipment that you would need replaced if damaged. Any property you either borrowed money to buy or have a lease agreement on, you'll need to have coverage for those items as required by the bank or vendor. With death and disability, even though it's not fun to talk about a cyber attack on your business, it's even less fun to talk about a premature death or a disabling event that could impact your business. Whether you as the owner, one of your partners, or a key employee is suddenly gone because of an unplanned event, it will put a lot of strain on the business, and without the proper insurance planning, the business may not survive. In particular, a disabling event, although more likely to occur, is actually less often addressed because people don't really understand what it is or what's at risk. For example, if you experience a temporary disability, you may not be able to cover your overhead expenses to keep the doors open and employees paid while you recover and get back to work. Or you may have a partnership agreement that requires a buyout if a partner is no longer able to work again. But without the proper insurance, you'll have to liquidate assets or severely leverage the company in order to meet the buyout obligation. What matters here is that you look at these untimely events and prepare for them appropriately. Know how much retention of risk you can stomach while figuring out how to insure the rest. Depending on your personal retirement needs, you can choose a few different options. There are CEPs, or Simplified Employee Pension, Simple IRAs, Solo 401ks, and traditional 401ks. Each have their pros and cons, as well as cost structures and limitations for contributions. Depending on your personal needs as the owner, your desire to contribute on behalf of employees, and offer an avenue for employees to contribute on their own, this will determine which option makes the most sense for you. Most small businesses will start with either a CEP, Simple, or Solo K, and as their needs change, they will move to a 401k. It's important to look not only at what your needs are today, but what you feel your needs will be in the coming years. You'll also want to know how predictable your revenues and profits will be to make sure you can meet the commitments of the plan that you select. If you do choose a 401k plan, there are several design options and support services you can get to help manage the plan in a way that your business requires. With the Secure 2.0 Act, you may qualify for tax credits that will lower the barrier to entry in these plans for the first few years. What matters is that you talk to someone who understands your needs and builds you a plan that supports your goals. Secure 2.0 significantly increased the available tax credits for newly implemented small employer plans. Certain small employers who establish a new plan are eligible for a tax credit for the first 3 years in which the plan is maintained to help offset the startup administrative costs. If you are setting up a brand new plan, your company may be eligible for upwards of $5,000 in credits to offset the costs of starting the plan in the first year. There are additional credits available for employers that provide employer contributions to a new defined contribution plan for employees making less than $100,000 in FICA wages. During the first 5 years, the credits will equal anywhere from 100% of eligible employer contributions up to $1,000 in the first year, to 25% of eligible contributions up to $1,000 in the 5th year. This will significantly help lower the burden for small employers to contribute to employees as they get started. To give an example of this, if an employee is making $50,000 and you contribute 3.5% of their wages, you will receive a $1,000 credit against the full $1,750 contributed in the first 3 years, followed by $875 in year 4 and $437 in year 5. Lastly, Secure 2.0 also requires plans established after December 29, 2022 to add an eligible automatic contribution arrangement, or EACA, to the plan starting in 2025. Since this adds some administrative complexity, the addition of the EACA will add an additional $500 tax credit for the first 3 years that the ACA is in place. The best place to start is determining why you are wanting to offer employee benefits to begin with, and what these benefits will mean to your employees and your company. These are just a few questions you should consider as you get started. Are you offering benefits because you primarily need them, or are you doing this for your employees? Are you trying to solve for a couple key employees, or are you trying to attract new employees and create loyalty among all of your employees? Are you looking to get to market standard, or are you wanting to differentiate yourself from your competitors? Do you have a budget in mind? And how do you plan to leverage the value of the benefits? Whether you are easing into your benefits program or jumping in with both feet, having a thoughtful strategy that accomplishes your goals is the best place to start. There are some benefits you can offer that are soft on the budget, while others come with a higher price tag but accomplish exactly what you want. The first thing we always start with is a discovery meeting to understand your goals and desired outcomes so that no dollar is wasted. The easiest place to start are things that you have complete control over, such as paid time off and holidays or flexible working hours. These are benefits that all employees can benefit from regardless of their situation and often don't come with a tremendous cost. Health insurance is normally the next place employers look to help their employees. This is a benefit that tends to be the most impactful for employees that really need it and are specifically seeking it out from their employer because they have no other option. After that, your 401k and employer match will be the most valued. A successful business succession plan always starts with knowing your business's value. Sometimes we see business owners stick around longer than they expect because they have all of their assets tied up in the business, not realizing the sale of their business won't meet their retirement needs. So they stick around a few extra years to catch up on some savings while holding out for a higher price tag. Knowing your value at all times will help you better prepare for a seamless exit and give you the freedom to walk away without regret. We provide informal business valuations for all of our business clients because knowing where you stand is the first step in knowing what you need to do next. From there, you need to address the things that could cause you to sell before you are ready. Typically, these are health-related things where you can no longer work and you need to transition out before you thought you would. Instead of being forced to sell when you aren't ready and selling for less than it's worth, having a protection strategy that keeps the business in your hands for as long as possible or ensuring it can be sold to someone for a guaranteed dollar amount will give you the flexibility you'll need when you're at your worst. For example, we talked about being able to cover your business overhead expenses while away so you can return to your business later and not be forced to sell when times get tough. Another option is to have a buy-sell agreement in place where a key employee or partner will buy you out if something happens while having insurance fund the transaction so you get exactly what you were expecting to get. Lastly, having a plan for what's next after you're gone. All too often people struggle in retirement because they feel they've lost their identity, because their business was their identity. This is also a big reason why people hold on to their business for longer than they should. Having purpose and a community are key factors for a successful retirement, because during your working years, you had both, and those will go away or change once you transition out of your business. So planning for ways to stay active, stay connected, and have purpose each and every day will ensure you feel prepared to exit when the time actually comes. There's really three main options when it comes to getting health insurance for your employees. There's fully insured plans, self-insured plans, and individual coverage health reimbursement arrangements, or ICHRA. With fully insured plans, generally you're paying a premium to the carrier, and they'll dictate whether or not you can get coverage for your employees. You will have participation requirements. Generally, around 75% of eligible employees have to participate, or you're not eligible for the plan. And you have to contribute a minimum of 50% towards the employee-only premium in order to satisfy their requirements. With self-insured plans, you'll have similar participation requirements, but the contribution requirements may be a little bit more flexible. The difference with self-funded plans is that now you are contributing to a claims account where claims are paid out of that account, and then large claims are going to be covered by something called like stop-loss premiums. Then there's individual coverage health reimbursement arrangements. This is where you are contributing to each employee's own individual coverage through the exchange. This is new since 2020, but this allows employers to not have to worry about participation requirements, and the contribution requirements are significantly less. You don't have to contribute anything if you don't want to, but there will be some fees you'll have to pay. You can contribute up to 100% for all employees. You can contribute on a percentage basis or a flat dollar amount. So it's very flexible. But the nuances with individual coverage are sometimes difficult to understand. You'll have to know that each employee will have access to coverage within their specific zip code, and every employee can choose any plan that's available in the marketplace. So there's plenty of options, but knowing what's right for you really depends on what is your budget, what do you expect participation to be with your employees, and what are the actual healthcare needs of your employees. We typically start with a discovery meeting to go through all of these things and make sure that we're building a plan that's right for you.